Hi, this is Craig Brelsford with RedChip Companies. Thank you for joining today's event with Alliance Entertainment, which trades on the NASDAQ under the ticker AENT. With us today, we have Bruce Ogilvie, Executive Chairman of Alliance Entertainment, Jeff Walker, CEO, CFO, and Director, Robert Black, the Chief Compliance Officer, and Amanda Necco, the Chief Accounting Officer. We will begin with a brief presentation in a moment, and then we will answer your questions. Users may submit a question at any time by using the Q&A tool at the bottom of the Zoom window. Before we begin, please allow me to read the Safe Harbor Statement. This call may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management, constitute forward-looking statements. Any statements that are not historical fact should also be considered forward-looking statements. Of course, forward-looking statements involve risks and uncertainties. I now turn this webinar over to the Alliance Entertainment team. Please go ahead.
Thank you, Craig. Hello, everybody. I'm Bruce Ogilvie. I'm Chairman of Alliance Entertainment, and my partner Jeff Walker is on the phone here with me. To tell you about Alliance today, Alliance, we bring entertainment to you. We are a stocking distributor of over 325,000 SKUs, and on the left-hand side of the screen here, you'll see all these tentpole suppliers that we work with. These are the gold standards of entertainment products consisting of movies, music, video games, and collectibles. We're a stocking distributor, which means we have this long tail of selection in stock of that 325,000 SKUs. We take this list of SKUs, this huge selection that we have of entertainment products, and we put it in electronic data feed files that we feed to all these omni retailers on the right-hand side of the screen. You see your Walmart, Target, Best Buy, all the usual suspects there. And they have physical brick and mortar stores, but at the same time, they would like to be selling online to as many consumers as possible. And that's where we come in, where we can really expand their selection. Their selection online is really going to be what they carry in their stores or their DCs. And that'll be very limiting when you're trying to compete against Amazon, which is the king of long tail. We can come in and expand their selection, have all this big, huge selection there of entertainment products that really attract eyeballs and consumers wanting to spend more money in their store or on their sites there. In addition to all these, now the beauty that we can do here for these retailers is that we help them mitigate any type of inventory risk that they might have because they don't have the expertise in dealing with this big, long selection of what to bring, what to stock, or what not to stock. If you went onto one of their websites and you ordered the product there, and you couldn't find it in the store, but you went to their, you wanted to find it online, you would go to their site, look up the item you look for, order it, and it'll arrive in your door within 2 days, and you'll be very happy. Open it up, and it'll look, perfectly pristine. And you think it came from Walmart.com or Target.com or even Amazon.com, but it actually came from Alliance. We're that back room that did all this manufacturing, not manufacturing, distributing and shipping out to you. So when it arrived at your doorstep, it looked like it came from that retailer, sold by that retailer, but Alliance was that. Almost 40% of our business is e-commerce fulfillment, where we're shipping direct to consumers on behalf of these omni retailers, as well as on behalf of the brands that we own. We have our own retail brands, which is close to $100 million worth of business, where we ship direct to consumers, selling on every marketplace in the world for Amazon and eBay, as well as any other sites there. On top of all this that we do here, we are a traditional distributor where we sell and wholesale products to brick and mortar locations, which we're showing here, like over 35,000 storefronts, not to mention the 2,500 independent music stores that are still in business today and doing really, really well, thanks to the vinyl LP being revitalized there. So as I mentioned, we bring entertainment to you. We're in a category that's close to $10 billion in revenue. Of our $1.1 billion that we do, over $250 million of it is exclusive distribution, where we're the exclusive distributor. As I said, I mentioned we have a big, huge product selection. I'm going to talk more about how we want to do our growth and future growth by doing more acquisitions like we've done in the past, and we have a very experienced team, which I can talk about there. One thing we like to mention everybody is that our float is pretty lightly traded. That can be a good thing or a bad thing, depending on your perspective there. But the important thing is that we're fully committed, and our employees also own part of the company also. So we're employee owned. And really looking to grow our capital structure in the future there with some type of S3 raise in the future there. As I mentioned, 10 billion physical market there. You can see the growth areas there are vinyl as well as licensing and video games are all three growth areas we're heavily involved in there. We think there's our growth areas here is just all these different areas there. We're definitely going to lean in heavier on the collectible side here. Vinyl still strong and video games. We are a little constrained as far as software being available there, but people still are playing lots of games, and to play those games, you need controllers, you need headsets, you need goggles and consoles, and those are all the things we distribute there. That 250 million that I was talking about, it's kind of three little tranches there: Distribution Solutions, AMPT, and Mill Creek, and then Arcade 1UP. So Distribution Solutions is 60 movie studios where we're the exclusive distributor of that content. We are the seller of that, and we're talking home entertainment of video movies. And then our AMP division is CDs. We have 90 music labels. These labels, we're the exclusive seller on that. So anybody that wants a particular movie or a music title physically, and we're the exclusive seller, they must buy it from us. There's no other place to get it there. That creates really good sticky relationships with our customers there. Mill Creek is our licensing division. That's a really strong category growth that we're leaning into there. We license content from the movie studios. Once we license that, that's going to be distributed through Distribution Solutions there. But if you, in the past, right now, and currently right now, we have Sony, Universal, Lionsgate, CBS, Paramount, and other independent studios. About a year and a half ago, we licensed the bottom 1,800 of the Disney titles. And we were hopeful that we would get on the RFP all their titles. We did not get it, but that didn't stop us, because now we're in the middle of a major RFP with another studio that wants to license their movies to a third-party company like us. And we think that over time this will be kind of the direction that all movie studios want to do. No reason the music side wouldn't want to do the same thing. And back in the 80s, the music studios, the music labels licensed their video content. Just recently, we have these retro arcades, Arcade 1UP, 74 million last year in revenue. We just executed an exclusive North American distribution agreement. So pretty excited about that. That's an item. These are retro arcades like Miss Pac-Man, NBA Jam, Pong. I'm sure you've seen them out there in the marketplace, and we're doing really well with those. And we expect this Q4 to be very strong in that area there. I was mentioning our acquisition growth. I joined Jeff in 2001. Between 2001 and 2013, we did like 4 or 5 different acquisitions there that got us up to, $190 million of revenue. In 2013, we acquired our largest competitor, Alliance Entertainment there. And then we just continued on that, the acquisition strategy there, mainly buying either competitors or buying other companies in areas where the current type of business we were doing is our way of diversifying. I think just the big picture here is that when we say we want to do acquisitions, we have a good track record of doing acquisitions, and we've done really well in that area there. This is just a little quick case study in Distribution Solutions. We acquired that in 2018 from the previous slide there. We acquired them about $80 million, and as of 2024, $134 million. The year they started out, with 18 studios, and today we're up to 60 studios there. A lot of times people ask us, what's your strategy for doing any type of M&A acquisition? What do you do? Well, we don't like to overbuy, but we start off as let's figure out what the standalone EBITDA is. After we've calculated that, is there any add backs or takeaways as a standalone there? Any synergies that we do get, we don't want to pay the seller for that. We want to keep those. That's for us. It has to be a debt-free transaction there. And the next thing we have to set the working capital or the PEG. And it's pretty simple. We take accounts receivable plus inventory less accounts payable. And that sets how much working capital business is required. And so once we know that what the EBITDA is, we'll come up with some type of multiple. We'll offer them for the business there. It has to be a debt-free transaction, I said there. And then they have to deliver a certain amount of working capital. If working capital exceeds the peg, that'll improve the purchase price. If working capital is less, that'll lower the price. Needs to be some type of seller note or earnout. And then of course we have to get bank financing approval, but now we have something new to work with, which is we could actually issue stock or do some type of raise to instead of borrowing the money to give shares of stock to save money. That's something we have not had before. It's been to ask, could we become partners in the business. As a private company, we found that very difficult to do. As a public company, we're very open to that now. Big turning point for us is our warehouse in Kentucky. We also had another major warehouse in Shakopee, Minnesota there. There we had a total, in Minnesota, we had a total of 192,000 square feet. And just this year, we were able to reduce that footprint down. We eliminated 162,000 square feet of warehouse space there. That's going to really improve our earnings for this year. And this all happened on May 31st. And how were we able to do that? Well, it was really simple. But 3 years ago, we found this company called AutoStore, which is in the upper right-hand screen there. I encourage you always to go to our website and get our deck and click on these links. You can see how AutoStore works, but I call it the Rubik's Cube of auto storage retrieval systems. And basically, you have all these totes or milk crates that stack on top of each other. Think of each one of those as a shelf location. Today, we're using it for vinyl. We have a lot of vinyl in there. And before AutoStore, we had 41 people walking around our mezzanine, going to different locations, walking down the most efficient pick path we could come up with. And then they would pick and process and pull it. Well, that 41 people would be able to reduce to 7 people. We're very happy with the performance of AutoStore, what it's doing for us. That same efficiency by eliminating that travel time there, going from 41 to 7, that's causing us payroll savings between $3 to $3.5 million. And then on top of that, receiving, we also save here. Instead of people receiving the product and walking to a shelf and finding an empty location, now they went down from 14 down to 7 people there. So that was an improvement. The next thing that AutoStore gave us is because it's all packed together and there's no aisles, that gave us more storage capacity. So as we moved the products out of our mezzanine into the AutoStore there, that freed up a lot of locations in our mezzanine, and then that allowed us to shut down our Minnesota facility there. Because of AutoStore, if you look at our 10K, you'll see that our fulfillment costs we're running over 5%. It's now down to 4.4. So we've saved over 1% for our financial statements because of AutoStore there, and it allowed us to close that facility, which is going to have more savings that are going to happen this year. Just the top line, you can see that revenue there. We had that big COVID spike there. So we did get a high peak of $1.4 billion there. But right now we're currently, we just finished the fiscal year at $1.1 billion, versus $1.158 billion there. Pretty steady Eddie, I would call that right now. We're obviously becoming more profitable. We had a supply chain issue with those retro arcades, which I can probably explain later on when we have more time there. So what's our strategy here? Well, we got to grow our market share, continue with automation and restructuring. We want to add new products through verticals, through M&A. We're a capital light model there, working capital improvements, efficiency, scale, and this is a way for us to separate us from our competitors there and create some distance there. Senior management, so Jeff and myself there, our board of directors. We have Amanda and Bob on the call today there. And then we have our 4 outside independent directors there. This is just a quick little help you out here. How did we get where we were? So June 30th, 24, we came in at $24 million EBITDA. And then the previous year, we're at 17.6, negative loss of 17.6 million. And you might be saying, well, what happened? And it really all started with some retro arcades back in 2021. And they got delivered very late. I'm sure a lot of you remember all those cargo ships that could not get unloaded. We had quite a bit of inventory off the port of Long Beach there. Long story short, container costs went from $4,000 to $28,000, and demurrage charges, transportation charges, carrying cost of interest. It all came in. We missed the holiday season, so after we started January 1st there with almost $130 million in inventory there. We had to deal with the fact that we had to discount some of that inventory to move it through. And that's what created that. If we were to add back all the costs associated with that one-time event there, you would add back 35.8 million there, and that would have made our EBITDA more like $18.2 million number instead of a loss of 17.6 there. You can see from a cash flow perspective there, because we did this, great turnaround from where we were, our cash position improved by $55.8 million compared to the previous year there. And mainly what's driving that is we were able to lower our inventory, lower our account, our line of credit, which I'll show you in this slide here. Whoops, let's go right here. You could see that right here in our balance sheet here. So inventory went down from 147 million down to 97 million. It was at a peak of 249 million at one time there. And you'll see our revolving line of credit there went down from 136 million down to 79 million there. So we're definitely making our balance sheet more improved. Probably have a little bit of improvement we can do on our inventory side there, but we're really happy with the progress we've made from where we were. Just to give you an idea of what our sales breakdown is. So 1.1 million in the revenue there. And you can see that, gaming is about 31% of our business. It was at a peak of 39%. You can see vinyl and where it's running. So right now about the 30% range there, it's holding up really well. You take the movies, 19%. And then if you add CDs, 12%, you can see that music as a category is about 42% of our overall business there. And our consumer products is down as a percentage of our business, and we're taking steps to improve those areas there. You look here, you see that, vinyl is going to have, continued growth, and the collectibles side is also going to have additional growth there. This is just, you can see our chart here, how our quarters are improving there. And so, we're happy with that trend. We're going in the direction we're going there. And that is it. I'm ready to open it up for questions. Unless, Jeff, you want to throw something in there that I missed?
No, I think that's head to questions.
What does Disney's new distribution deal with Sony mean for Alliance? Are you still distributing content for Disney? Could Sony outsource some distribution to Alliance?
Jeff, you want to do that? I'm happy to.
Yeah, I'll run with that one. Yes, we are still distributing the Disney product. We purchased it through our Sony account now, the titles that moved over there. But they've also they've kind of split it. The main tentpole new releases are going through Disney there. Going through Sony, and Disney has moved over some more titles to Alliance under license since they announced that with Sony. You have to realize Sony's got their own core products that they are focused on and so forth. And so we're kind of in a combination there with Disney, as well as at the end of the day, Alliance is the third largest physical account to all the studios. There's Walmart stores, and then there's Amazon, and then Alliance. So we are a significant account for Sony, Disney, or any of the other studios.
Hi, Bruce and Jeff. I have been to your facility, and the automation is breathtaking. Can you speak to the competitive landscape? I am having a difficult time believing there are many competitors with the same functionality.
Yeah, as far as, well, from a 3PL perspective, you have Technicolor, which is Vantiva, and the other one, Direct Shot. And Direct Shot is not as automated as we are. And the other two about the two competitors is the competitors, as far as fulfilling product and doing like what we're doing, they're not really the seller of record. They're just a fulfiller of record. So they don't have that direct relationship with those retailers that we have there, which is very important to us. As far as Vantiva and Technicolor, they do have an auto store piece of equipment now that was put in there by Universal Music, and there's some arrangement going on between them. I don't believe Vantiva financed that, but I think Universal financed 100% of that. And Vantiva does have some type of sortation equipment for sorting different boxes and products. We're really happy with the way our operation is working, and we probably, because we're so heavy, well, the collectibles space is a different category from an automation type perspective, which is currently not being involved in Vantiva, a direct shot there. As far as, like a Solutions to Go, I've never been in their facility, so don't know what I can say about them. I suspect they have some automation there. And then AMS is one on the music side there. And I'm not aware of any automation they have there.
Do you anticipate paying off debt at the same rate in the next 12 months as you did the last 12 months?
In a total dollar amount, I would say probably not as much. A big portion of paying down our debt in the last fiscal year, ending June of 24, was a real reduction in inventory that helped us as we converted inventory to cash. We will probably end June 30th of 25 with a little bit less inventory than we did in 24, but not a significant number like it was the year before. But on the other side, we are generating increased profits here in fiscal 25, so that should help to contribute to our debt reduction here for fiscal 25. And I guess one bright spot in some of the write-offs that we took in fiscal 23 is we do have a pretty significant tax loss carry forward. So even though we're booking tax expense, the cash paid on taxes for fiscal 25, I think will be very minimal because of our loss carry forward that we have. As we have brought down our our borrowing over the last year, and our borrowing is significantly lower here in fiscal 25 than 24. Our interest expense is coming down, as well as, every quarter point or every, half point adjustment on the interest rate definitely has an impact on our profitability and ultimately our loan balance at the end. So that is going in a favorable direction for us this year, that, reversing what it was the last couple of years.
All right, gentlemen. Next question. Here we go. Excluding vinyl, what percentage of sales are physical, that is non-digital entertainment? And can you discuss what types of consumers are still buying physical entertainment?
Well, we have a slide that put up on the screen there as far as the breakdown by configuration. We're definitely seeing, at the end of the day, I think all of the products start to run into the world of collectibles. And, obviously people have vinyl collections. We all had DVD collections, or people have DVD collections. People had CD collections. People have collections of toys. People are collecting arcades. And I think that's really where we're at overall in the product that we have to sell. In respect to DVDs, we are seeing a stabilization there as well. People are buying more of the 4K DVDs, as well as steel books, which are more of a collector edition of their favorite DVD that they want to have at home. And then we've had a really strong growth in K-pop, and K-pop is primarily all CD, but there are collector boxes with a bunch of different other photos and different limited things that they put in with the CD that create a collector's edition there. And so we just see more and more of our business being all about collectors, and people want to collect music, movies, games, anything related to those. And that's where we're going to continue to focus our business.
Thank you very much, gentlemen. Would you say collectibles is your primary target for acquisitions? If not, is there a specific area you are looking to increase exposure to?
Yeah, that's a good question. You know, with our wide different categories that we are in, we definitely see acquisition opportunities in all the different categories. I will say that in the collectible space, there is a lot of acquisition opportunities there. And one thing that you have to realize is that we're in the world of franchises. So you have movie franchises, TV franchises, gaming franchises, anime franchises, even musicians are franchised on their own. And within all those franchises, they have very significant licensing departments, and those licensing departments are licensing to an enormous amount of licensees that then go and create products revolving around those franchises. And it can be anything from hats to t-shirts to sneakers to toys, collectibles, and all those different things that you can think of. For instance, you know, go to a Harry Potter store and you can see all the different types of products that they put the Harry Potter franchise on. And so when you look at that, there's definitely a huge opportunity. The licensees, there's an enormous amount of licensees that go and license from those licensors and manufacture all these different types of products. And so when you look at acquisition opportunities, just with licensing of entertainment products, primarily there is a lot of acquisition opportunities and consolidation and roll-up opportunities within that area that we're definitely in multiple conversations in that particular space.
Would you be open to a private equity investment similar to what Earth Entertainment has done in recent years?
Are you referring to Entertainment Earth?
I believe that's
private
that's the
equity?
question. Yeah, and I think they just got it backwards, but yeah, that's the main entertainment. I'm pretty sure.
Well, you know, they're a private company, so you know, now that we have moved into the public market, you know, we have really the public market if we need to raise capital for any type of acquisition or component there. And you also have the situation now with us as a public company. We can merge with a private company that wants to, you know, that makes sense for us to put the two businesses together. And you know, there's a component there where the seller might want to take some stock as well as cash in consideration for that. So it gives us some more opportunities there, being on the public side as well. And one other thing, kind of, I guess, a little off topic of this question, but one of the wins for us in an acquisition, now that we're in the public market, is when we moved to the public market, we wanted to make sure that all of our employees with Alliance are owners in the company. So we did a stock award for all of the employees. It was over 600 employees that received a stock award last year as after we went public. And it's important for us to have our whole team as employee owners in the company. And so now when we look at acquisitions, one of the other components in that is people from the acquired company would be coming over into Alliance, and we would also want them to be owners in the business. And most of the conversations we're looking at is something like a stock award with like a 3-year vesting schedule for those new employees, so that we would have something to offer the new team that is joining us. So that is a big difference, and it's an important difference when you're looking at doing acquisitions and trying to integrate a new team of people into the company.
Are any of your arcade games I am seeing at retail, Costco, for instance, part of the old inventory glut from COVID?
On the arcades, we're pretty much through all the excess inventory that we had. We have about 4 or 5 titles that are on a sales plan that will be sold through here in fourth quarter. We don't have that many units left. I'll give one little example. I think we started with 29,000 units of Simpsons several years ago. We had a lot of pre-orders from everybody on that, and I looked earlier today. We have 4 units left. We're down to our last 4. I think we'll be sold out tomorrow or the next day. So,
Jeff, I think the question was, is that inventory currently at Costco, as you know, that was sold directly by Arcade and Costco have a direct relationship. So we're not involved in that at this time.
yeah, correct. Those were arranged prior to our exclusive deal in July.
Correct.
Thank you, gentlemen. What are your plans related to the VR category? It seems weird. There's no plan in place that we can tell.
Well, the number one VR category is Oculus, and they're really tight on their distribution. They just want to go direct to retail. They don't have any current distributors at the time. Not that we haven't been trying to get it.
I also one last thing on VR. It's probably been almost 8 or 10 years, I think, since we were seeing a lot of VR, and it was the next year it was going to be huge in consumers' hands, and we really haven't seen the adoption from the consumers on VR yet, and quite honestly, not a huge amount of press and hype on it today. Not any more today than it was 8 or 10 years ago.
Oh, that's fine. What is the percentage of capacity available at the Kentucky facility?
Basically, the Kentucky facility, any excess, if we have any slow-moving inventory, we would move it to cold storage. We store a lot of inventory for the movie studios, and the independent movie studios are the AMPed labels, and they kind of treat them like their children because it's their own inventory. It's consigned inventory. We charge storage for it. So if we needed to expand any like auto store system or anything, we would just move, convert pallet racks into auto store, or possibly more mezzanine. But we still have a long ways to go before we could ever max out that building with additional automation.
Yeah. One other thing to add to that, maybe 5-6 years ago, before COVID, we really had some real crunches right around Thanksgiving week and Cyber Week there, because e-commerce fulfillment was really, really crazy during Thanksgiving week. And I think there's been a shift overall with the retailers, and not only brick and mortar with their e-commerce, but Amazon as well, to do a lot more promotions. Even you're starting to see stuff. Amazon Prime Day just happened. Target just had a big thing. Walmart's got stuff. October, November, December, they're all realized that it really needed to spread out all that e-commerce business over really almost more like a 60-day period than all in 1 week. And so that has actually really helped our business overall by splitting that out more. So we get more of a consistent busy flow on e-commerce than the crazy crunch we used to get on Thanksgiving and Black Friday. So when you talk about capacity, you always talk about what's the choke point, when do you get choked out and maxed out on something, and that really changed the dynamics with that whole shift there.
Would ideal M&A targets have distribution capacity of their own, or would their business be integrated into Kentucky?
Well, I think, I think it really depends on the scope that, you know, and the level of distribution that they have and where their facilities are as well. If it's a smaller, uh, acquisition, it would, probably get, moved into Kentucky. It just really depends on the scope of the business and the size of the business. You know, we've done acquisitions that, can have 20 to 30 million in revenue. And, you know, our largest one was when we did Alliance back in 2013 with 700 million in revenue. And so, you know, if we have a big acquisition, it'd be more than likely that we would, maintain some forms of their distribution facilities.
The strategic advantage of being in Louisville, Kentucky is, you know, we're right next to UPS. And the same advantages we have being next to UPS, other companies have, you know, whether they're Memphis with FedEx, but we basically get, you know, next day air service for 2-day air rates. We have really late cutoff times. And you say, well, how do you get a next day air service with 2-day rates? Well, the 2-day air sort is done in the daytime. So if we have to get something to a store tomorrow, today we had till 11 a.m. this morning to get a 2-day air package ready to go. They would pick it up, they do the sort in the afternoon, and then it would go into the planes tonight, leaving Louisville across the country as part of their air sort for when the planes come in. All the planes come in start coming after 11 p.m. They unload those planes, and then they resort all those packages and reload the planes with the next day air packages, adding in the 2-day air packages, and then everything gets delivered tomorrow, the next day. That's the beauty of being where we're at. And you get the same benefit if you're in Memphis.
Should shareholders anticipate any major issues to be voted on during the upcoming shareholders meeting?
No, nothing. The only thing we're doing is asking to expand our RSA, how much we could do in the future of RSAs.
Back to the question about VR. Is Oculus the only player in hardware and software? And what if we suggested the adoption rate is more significant than how it was characterized? Break down how they dominate. Is it hardware on up so the investors who are confused can understand?
I don't think we can really help you with that question, the detail you're asking for there. Yeah, I mean, the closest we got to VR was with Sony, when Sony was pushing in the very beginning there. And then outside of that, it's been very tight distribution for distributors. The belief is to work directly with the retailer and bypass the distributors, what I've seen so far.
I'm not seeing any more questions in the queue. I'd like to offer you the opportunity, gentlemen, to send us off with the value proposition. Why should an investor take an interest in Alliance Entertainment right now?
Sure. Well, we're extremely undervalued. So it's a great opportunity for investors to get in when everything's on sale. We feel as we just keep producing results every quarter going forward, and then recognizing that we will do some type of, capital rate, not raising capital just to increase the float, because we know we don't have enough. We need to get above the $5 price target. We're not going to raise money at a $3 price or $2.50. It really has to be above $5 before we would consider such a raise. So getting in now does not mean you're going to get clobbered because of some type of raise. We don't need to do a raise or raise money just to raise money, because we're not losing money. We're not burning cash. We're producing cash. So it's really any type of increase in the float is used for the sole purposes there of just trying to get the stock, above $5, get it up to, $8 or $10, where we like this, where we like it to see. So good value, strong management team. Jeff and I have been doing this a long time, plus the people around us. We did all these acquisitions. We really have ended up with the cream of the crop of all these companies and their expertise. Jeff and I always look at when we acquire a company, which company has the best practices, what can we learn, what can we borrow, what can we use to make us better and really improve shareholder value there. So that's our strength there. We're working very aggressively right now, trying to get some acquisitions done. That's something we'd certainly like to announce, before the end of this year. What ones that are, how they're moving along, what they mean, and what the terms would be. But we're doing this primarily to diversify, improve our gross profit, increase our top line revenue, and make everything more accredited there.
Yeah, I'd like to add on that. I think it's, we've got a lot of great new organic growth opportunities within the business with different studios and labels that we're in conversations with. We are also not exploring, but we're already working on significant sales and growth in live commerce, TikTok, Instagram, kind of the social mechanisms of selling product, which is different than your Amazon, Walmart, and Target websites and so forth there. So that's a big component. And then definitely heavily in the collectible space, as we mentioned earlier. A vinyl's collectible for sure. Obviously, collectible toys and figures and so forth there. We also are very focused on improving our gross margins and focused on products that produce higher gross margins. So I guess that's also kind of one of the reasons why we're not that chasing down the VR hardware path, because we just feel that type of hardware sales, while it might produce top line revenue and so forth, is a fairly expected to be a fairly tight margin business there. So one of the areas we're definitely looking to expand is more licensing with the studios as far as DVD product under license, like we do currently with Disney. So we're in several conversations there, which is much better margin in video than a distribution margin. And then other potential licensing opportunities within collectibles and stuff as well there. So the ecosystem of entertainment franchises and the amount of products that are produced and sold and collected by people is a huge market that's going to continue to grow. And we've got a $1 billion platform and a solid business and great warehouse operations to be really the last man standing in music and video, and then have significant collectible and licensed business along with that as well. So that's where we're focused on today.
One last thing, I see I was kind of called out. How is it undervalued? What multiples is that based on? I think that was Ben Rubenstein I'm seeing there. Ben, so I'm basing that on two different research reports. One just came out this week from Think Equity. They have a target price of $6 using our forecasted 2025 numbers there. $38 million EBITDA number there is what he has in his model there. Trickle Research just recently updated their research report right in the $4.50, $4.75 range. So not quite the same $6 range as Think Equity there. So we know what we're shooting for. We know what the bar is. We don't disagree with any of those numbers that are out there in the marketplace. We feel that they're obtainable, and that's the direction we're headed.
Thank you very much. For more information on Alliance Entertainment, reach us at 1-800-RED-CHIP. That's 1-800-733-2447, or email us at aent@redchip.com. Please visit the information page created by RedChip for Alliance Entertainment. It's aentinfo.com. There you can view and download the investor presentation and fact sheet and sign up for news alerts on Alliance Entertainment. Please be sure to watch Small Stocks, Big Money, RedChip's program featuring exciting small cap companies every Saturday night at 7 p.m. Eastern on Bloomberg USA. Join RedChip's forthcoming webinars, Nutriband on Thursday, October 17th, Phoenix Motor on Monday, October 21st, and Gorilla Technology Group on Thursday, October 24th. All webinars start at 4:15 p.m. U.S. Eastern. Register for those events and for all Redshift webinars at redshift.com/events, where you can also view an archived version of today's webinar. Thanks again to our many participants, and thank you very much, Alliance.
Thank you.